And I think it's different where you're one-to-one as a joint venture partner. I think you just want to make sure that they have a proven track record of business. And I wouldn't say take for granted like how long it can happen, because there's someone in my community that's been doing this since I think 2012, and she just filed bankruptcy for one of her companies. And I think it stems potentially from
especially new investors deciding when is it the right time for me to enter a free community versus a paid community.
There's kind of a quote that says only those who risk going too far will ever know how far to go. Yes, there could be some setbacks and stuff like that. I wouldn't be where I am had I not.
Joining us today is Serena Holmes. Serena, can you tell us a little bit about your background in real estate and how you got started in the industry?
Yeah, for sure. So I used to run my own agency. It was all about staffing and experiential marketing. And I guess it was back around 2012. So we were about 8 years in, and I was like, I should hire a business coach. Like, I'm sure there's lots that I don't know. Like, I've been winging it. And my first coach was pretty expensive. Like, she was $1,200 a month, I think, for 2 meetings a month. And the two big takeaways were managing my margins. But the other thing was really just how much money that you need to operate on. So at that point in time, we had, a year and a half of operating costs in the bank. And she's like, this is a waste. Like, why would you just have this money in the bank? I'm like, well, we ever don't make sales for a while. Like, I can pay for anything. Like, and she just really encouraged me to start investing. So she said, most business owners only operate with 3 months. You have like 18 months. So she encouraged me to take out some money to start investing with. So at that point in time, I wasn't really sure what I wanted to do. And because I was self-employed, I just felt like I couldn't qualify. Multifamily was definitely not on my radar. So I ended up buying a short-term rental in Florida. And it was back when the dollar was at par. So when's that ever going to happen again? So I was able to basically buy it for cash between the money that I had in my business, as well as some money on a HELOC. And I kept that for 4 years. Pretty much ran at a deficit the entire time, because the people that I bought it from, they made it seem like it would be booked all but 8 or 9 weeks of the year. And it was kind of the opposite. Like January to March, no problem. I could book it probably 4 years in advance. But the whole rest of the year was vacant unless we got like a bonus renter at different times of the year. So essentially I was able to at least keep it for a period of time. And then when the dollar shifted, I sold it and went back to the drawing board. So kind of started educating myself more and, diversifying in terms of what I was doing.
So what attracted you to the short-term rental side initially versus just a standard put a tenant in there and kind of hopefully let it run itself? Because I know short-term rental tends to be a little bit more active. And you obviously had your business that you were running at the time. So what inspired that?
Yeah. I mean, it wasn't overly active because where it was at a country club, basically. It's a golf course and country club. So people that came usually stayed for 30 days. So it wasn't like we were turning them over weekends and stuff like that. So more often than not, you do get the same like snowbirds that come down January to March. So in that sense, it wasn't heavy turnover. Like I did still have to learn, navigating having a rental in the States, having like American bank accounts to pay bills and transferring money around and things like that. But it really just came down to what I could afford and pay for in cash, just because I didn't feel like I could qualify for very much here. And at that point in time, I didn't know anything about commercial real estate. So looking back, if I knew that, like had I gone into multifamily then, like I think I would be maybe a little further ahead in different ways at this point in time. And obviously it's a lot easier to qualify for commercially because it's the NOI that's basically qualifying you, not necessarily your personal situation, right? So being a business owner, like I paid for a lot of expenses through the company, kept my pay relatively low, which is fine from a tax perspective until you need to qualify for something, right? So then they're like, this is all you make. And it's like, well, not really, but like that's how they look at it, right? So it was just at that point in time the easiest step into the market based on the fact I had no background and no education.
Why the States? I mean, I know I get the appeal to it, and there's a lot of people that want to invest in the US, but as your first property, like, I mean, at this point you were living in Canada, right?
Yeah. So in particular, we have family that have been in the States for I don't know, since 94 or something like that. And I had an aunt and uncle in that area, so they were only 20 minutes away, so I could lean on them if we needed help. There was family friends of theirs that had a unit in the building right beside ours, so they were kind of showing us around all the different places. And it really, the big thing was just buying things at par, right? Like we knew that this is like this unique window in time where dollar for dollar were equal, and I knew that I was banking on that more so than the market shifting. Like in the span of those 4 years, it went from being part of like $1.37 to one. So that was really where I made the majority of the profit when we did eventually sell.
Okay, no, that makes sense. So you decided, okay, well, maybe this isn't the strategy for me. So what happened after you sold? What did you do then?
Yeah, I mean, again, it was operating at a loss, and it just felt like it was this tiny little, like 1,100 square foot condo. Everything broke, everything. Like I think the air conditioner broke 3 times. The springs in the windows went, the furniture's falling apart. Like it was beautiful, but it was just like that time span when everything kind of starts to go within it, and it just felt
Yeah.
like an obligation. Like it felt like we still had to go down there at least a couple times a year and check up on it and stuff like that. And it was nice to be able to spend that time with family, and it turned out like neighbors of ours from the cottage I placed 10 minutes away. So it was nice to have those things, but it just felt like it was becoming more of a drain. And when we were at the point where we wanted to start a family, it was like, we just only want to keep going back there with the extra time that we have. So I ended up selling it. I didn't know what to do, but I ended up staffing events for a really well-known real estate education company here. And it put me on their radar. So I went to their wealth tour, sat through the 1 hour, and of course furiously wrote in a notebook. I'm like, oh my gosh, there's all these things I don't know. So I
Yeah.
signed up for their 2-day event, and then it led into their membership. And I was on the fence because it was very costly. At that point in time, it was $35,000 to join. And I met someone that was the mother-in-law of one of my staff that gave me the encouragement and the push that I needed. She's like, it won't be a waste if you're ready to take action. And at this point in time, I did have money that I intended to invest with. So I went to their investor summit and I bought 2 pre-construction properties. I invested in 3 syndicated mortgages, a land development deal, and then I was introduced to private lending. So everything just really snowballed at that point in time.
Wow. Okay. Yeah. So yeah, quite the snowball. So like, what were the pre-construction properties? What were some
Yeah.
key lessons that you learned from that experience?
Yeah, I wouldn't do it again. Just because I had the money available and it was kind of the easy thing to do at that point in time. But first of all, you have to wait for the property to be done. So you're not making money on your money right away. You're waiting. And again, multifamily was just not then what it is now, where I think looking back, I wish I would have found someone to partner with to, joint venture on a multifamily property where we can improve it and keep on repurposing that initial capital. But at the time, it was the opportunities that were at hand. So at least I was doing something. But I bought a pre-construction condo in Langley that I intended to sell on assignment. And it took about a year longer than intended, which isn't too bad considering like in Toronto could be like 5 years longer. But it only made probably about half of what I expected it to make and what was projected. And then I kept a long-term tenant in Edmonton. So it was basically a suited property where I was renting the main floor and the lower levels. So I kept that for 4 years.
Okay.
And it did appreciate in value. And then I decided that I would sell that and I would ideally move into multifamily. And it was right around the same time interest rates were changing and stuff like that. So I kind of shifted everything at that point in time.
Okay. And so you moved into multifamily, and I take it you went the.
No, I wanted to move into multifamily. That was the plan. So I sold it with the intention. So I put in an offer on a property in Cape Breton. And it was a package of
Okay.
properties. So it was about, I think it was like 30 units across 6 properties. It was kind of an interesting thing. And my plan was that I would buy it sight unseen, but I would go there for due diligence and everything else. And I guess the seller was uncomfortable with the fact that I hadn't seen it yet. So they actually chose the offer that was a lower amount just because that buyer had physically seen it. So at that point in time, I thought, well, maybe this happened for a reason. Like maybe there's just stuff that I don't know. So maybe I need to educate myself more and learn a little bit more about what I want to do. So I ended up dumping all that money into private lending, what was supposed to be a year, so that I could take that time. And I explored a lot of different things like short-term rentals in, various places like Tulum, Costa Rica, Curacao. I looked at midterm rentals in kind of the Midwest. I was exploring like joint venture on a multifamily in the East Coast. And my plan is that all that money was supposed to come back last summer. And then I was notified a little before saying, oh, everybody has to extend by 6 months. So that was supposed to come back January. And then the mortgage broker I was working with kind of imploded. So now everything is wrapped up in a whole situation at the moment. So I'm cautiously optimistic it will eventually get resolved, but it's tied up in so for proceedings and insolvency protection at the moment. Some of it is outside of that direct to borrowers. So we've been left to try to connect to those borrowers to find solutions. So I really thought I was really widely diversified with 9 or 10 different borrowers. And then all this happened like just in the last couple of months. So, me and 500 other investors are all grappling with that at the moment. But I think the silver lining, like I'm young enough to recover. Like there are a lot of
Yeah.
investors that are in their seniors or were using
Yeah.
HELOC money and stuff like that, and they're really struggling right now. So, yeah, so lots of lessons kind of going through that whole process. That was really unexpected, but like I said, I'm cautiously optimistic that it's going to get resolved. It's just going to take some time.
Yes, that is. I think that's a big worry right now. In general.
Yeah.
Would you mind touching on some key lessons that you've taken away from there? Had you had the opportunity to start over and do this from scratch, what would you look out for this time, and what due diligence can others look into to sort of follow that path?
Yeah. So, when I had started kind of going more into this path, I was introduced to the concept of private lending. And I think I was really blessed in a way that, I did 60 deals in 5 years, all unsecured except for one, and everything was fine. Like everything came back on time or early. There was never any delays. And then as of last summer, everything kind of started to shift. And looking back, I think I just got a little bit too comfortable because everything had gone so well for so long. Like I'd even been living off of it for a few years, really, and it was really stable. I think with the money that I had put in, like I regret not putting it into secured first position. But again,
Yeah.
I wasn't really that worried about it because I was so well diversified and no one could have expected this. So that's one thing. Not to say that it wouldn't change what happens. Like the people that are in the secured mortgages are basically in the same thing, like in the sense that everything is paused while these borrowers are in CCA protection. So they're all on pause. They know they're going to be taken care of. Like as the assets start to refinance and sell, like they'll obviously be paid out first. So
Yeah.
there's been some lessons there, but specifically with this mortgage broker, I think, again, I thought I was very diversified. I think now I would probably never trust any mortgage brokerage with any, like just with everything. Like, I always
Yes.
believed in diversifying, but I never would have thought I would have to diversify even to that extent. And there were some things that that mortgage broker were doing. Like they had offered one option for people that if you didn't want to assume the risk with the borrower, that they would assume the risk. And I didn't go down that path, but that should have almost been like a warning sign because like how would they possibly be guaranteeing this and taking the risk when there's no assets to back it? So there's probably about 400 plus investors with 80 million invested that are in this fund. So they're actually now an arm's length away from the borrowers. So just that whole situation with those investors is a bit of a mess. There's more due diligence I think I would have done with the properties. Like again, with promissory notes, because they're not registered, you don't see
Yeah.
everything. So what we're seeing now that the investors are all together is like, yes, they had mortgages on the properties, but they were using promissory note money for the down payment and closing costs. Then they were doing
Yes.
more promissory notes for renovation. So in some instances, there's 3 or 4 promissory notes on a property, and the debt on the property actually exceeds the value of the property.
Yeah.
So now that we're literally seeing it, like we have a Google sheet where everything is shared together. So everybody's just like, oh my gosh, like when you see the scope of that, there's no way that you could have necessarily known that. So I think we're learning a lot through that. And then the other thing is that the mortgage broker offered 3 options for first position that you could have a 100% loan to value and get a certain rate. I think it was like 13%, 90-10, and it was 12%, or you could do 80-20, it was say like 10 or 11% because they're private mortgages. And thinking
Yeah.
back now, I'm like, why would any brokerage be offering 100% loan to value? Because obviously when the market shifts and the property could be worth less than the mortgage, right? So there's a number of things that just looking back, I think, they had a great reputation. They'd been around for 10 years. They had 305-star Google reviews. But now looking at it, there's no way we could have realized like how few borrowers they work with and how many lenders there really were and how much lending was facilitated. Like one of the borrowers has, I think they owe 4 to 5 million and they only have a couple of assets. So like they don't even have the assets to support it. Right. So the plan that they presented to us as lenders is that it would take like a flip of a for 2 years just to pay off our principals. And it's like, or they could go bankrupt. So it's like, those are our options. Right. So I think we're trying to be very patient and understand like the best way to work with these borrowers that we had no relationship with till a month ago or 2 months ago. So there's been a lot of lessons and learnings and stuff like that. But I think I just regret not sticking to my guns in terms of I had kind of like a minimum I normally do with like one person and just diversify as much as possible. And there were instances where I bent on that a little bit, and now I'm kind of left in this situation I'm trying to navigate.
Now, for the listeners out there who are like, what does Serena mean by diversify? Would you mind diving into that a little
Yeah.
more?
Yeah, so with the private lending I've done, like technically I have 19 currently out and 13 have been paused. So with this mortgage broker, I think I had 11. Two did pay out and I have 9. I have another 3 with another big company that was really, really well recognized and respected in this community I'm part of. And they have had kind of the perfect storm of things. So again, normally I would do 1. So say I would do like 1 P-note at 50,000, I did 3. So, and looking back, I'm like, I should have only done the 1. And my husband also had some
Yeah.
funds in place. And I regret that we work with the same investor, where I think you just want to work with as many people as possible. Like do the minimums. Like if you have 200,000, like do 8 or do 10, like split it up as much as possible. And with people and companies that have absolutely no connection to each other, just so that if one of them runs into a problem, you've got 10 others that you can fall back on. Right. So I think when I talk to people, sometimes they're like, well, at 400,000, I was thinking of doing 2. And I'm like, no, don't do 2, do 10. I'm like, but I didn't even follow my own advice because I got a little comfortable with the reputation some people had and the work that they were doing. And now they're in these situations where they're over leveraged and they're having challenges, and we're trying to work with it. I'm just hopeful that even if it takes time, I'd rather them take the time to work through it than just go and file bankruptcy or something like that, right?
Yeah, exactly. Okay, so you mentioned the investors, and I get that is if you've worked with one before, like it seems like a no-brainer, we've done this before, why not do it again? So I get the fact of splitting that up, diversifying across the board. Were you diversifying in terms of location as well?
Yeah. There's
Okay.
definitely like a big breadth of location, like literally across the country. I wouldn't say I really necessarily did too much into the States. Like there are opportunities there as well. But in this instance, it was all Canadian based. So definitely in terms of asset class, in terms of location and what they're doing.
Okay, so diversify in terms of the investor, asset class, location, and your takeaway would be, if you had to do this again, diversify in terms of the mortgage broker as well,
Yeah.
right?
Yeah, absolutely. Yeah. Yeah, you kind of thought, well, they're diversified for you, right? With all these different borrowers. But now understanding the scope of everything with those borrowers, like I wish I had looked into them in a little bit more detail to know, like, I would never have known all of this stuff then, right? But I think I definitely could have looked
Absolutely,
into them
yeah.
a little bit more. Just even understand the connection between them, right? Like when the CCA stuff happened, I had no idea there was any connection between these companies. And there's 9 of them or 10 of them that kind of entered in together that everybody's like, are they subsidiaries of a holdco? Like, how are they even connected and all of that, right? So I think everyone's just confused about how all of that even happened.
And would you ever do a promissory note again?
I think some people have asked me that. I think that I'm not going to say I absolutely wouldn't. I
Yeah.
think I'd really want to know the person in great detail, but I have learned a lot from it. Like with this mortgage brokerage, they had it indicated where it kind of felt like there's a quasi security. Like in the event of a default, you could put a lien on the property. So everybody felt like that was almost this measure of security. And as we're learning, that doesn't necessarily provide you with that security. The only way to get almost to state your claim is by literally filing statement of claim. That's the only way to register your interest. And then you go down that process of getting a judgment and stuff like that, or settling out of court. But you're technically, that doesn't hold a lot of weight necessarily. So I think the way that that was worded was really misleading to people. The other thing I've learned is that you can't file a PPSA, so with the Personal Property Securities Act, without a general securities agreement. So if you do go into a promissory note, you want to have the GSA to accompany you with that, so that if there are any issues, you can register a PPSA, because without the GSA, you can't do that. So that's just one added measure of security that you can register against a company. So I do have one company that offered that, but then this brokerage didn't have it, and I didn't know really the true value of it at that point in time. So just learning the laws around it and, what could happen in an instance that you run into issues, right? Like, what's your recourse and how do you recover at that point?
Yeah. Yeah. So how much do you currently have tied up that you're waiting on?
It's a lot. That's a lot. Yeah, it's significant. So, yeah, I mean, there's a lot of people with money. There's one guy that, from what I've heard, I think he has like 7 million in unsecured that he's waiting on because he has his own business. So he does have some secured, and he's got like, so I don't have anywhere close to that, but it's not an
Yeah.
insignificant amount of money, right? So it's money
Yeah.
that, I obviously don't want to lose, but I'm hoping to recover at least most of it. It's gonna take a while.
And what's the game plan from here on out for you?
Yeah, so obviously I have my real estate license. My business couldn't really operate during the pandemic. So since I had been investing in real estate already, I thought, well, I'll get my real estate license. And I think what I didn't realize at the time is how different it would necessarily be in respect to the client relationships. Like, I had my
Yeah.
own business for 18 years, but the reality is that we were B2B. So we worked with big corporate clients at Rogers Airport, consumer packaged goods. And what I wasn't really expecting was, the range of emotion that you can deal with when you're dealing with residential clients. So it's just a very different dynamic in terms of working with them and just the expectation. And, sometimes the level of professionalism can vary significantly. So,
Yes.
I think my priority and my preference is still on the real estate investing side. Like, if there's a way I could try to find working with clients more in that capacity, I think I would, in general, be happier. But ideally, when these funds are recovered, my plan is to ideally joint venture on a multifamily property and find something probably in the East Coast that we can improve and just keep repurposing that capital from year to year.
Okay. I get that. And tell me, are you only on the residential side for your license, or are you on the commercial as well?
Currently residential.
Okay. And on the multifamily side, are you looking to go the value add route, or sort of what the new craze is, at least I can speak for Edmonton here, is
Yeah.
the new build route, the infill route, where people are taking a big lot and they build in 8 units on there, 6 units on there. What's
Yeah.
the game plan for you?
Yeah, I mean, I have relationships through my mastermind with both. So I had narrowed down in the last year what concepts I liked. And I think, again, going back to diversified, I could work with a couple of them. I know someone that builds 8-plex purpose-built rentals in Edmonton and Calgary. So I've got a connection for that. And again, the number is really attractive just in terms of how they break that down. And there's a lot less red tape in Alberta. So things can move along fairly quickly in terms of building compared to other places. And then on the flip side, I've got connections with people that acquire properties in New Brunswick, specifically like Mountain. And again, ideally, you can move fairly quickly through that, and it's very landlord friendly there. And you can get the refis done within a year, and again, keep on repurposing things. So I think that was the goal, just because I don't feel like I'm necessarily in a position where I would be the active investor taking on a project like that. But if I could learn from someone that's been there, that has the systems, like at least to start, that would be my preference. And then if I can kind of learn along the way, then maybe it's something I would take on later on.
Okay, so the game plan for you is to get out of the private lending, get more into the joint venture side, being the money partner, and then potentially down the road transition into being a little bit more of the active partner.
I think I would always do both. Yeah, I think I would always do both. Like, my thought was that
Okay.
because I have access to money with my HELOC, like, I think there's still a value to the private lending and having the passive income and the cash flow. And then with the cash and whatever I make from my active earnings as a realtor, then ideally I would just put that directly into more like long-term equity plays and acquisitions.
Okay. Yeah, no, that makes sense. So going forward, looking to evaluate potential joint venture partners on the multifamily side of things, what are some key things to look out for people out there as well, who are potentially in a similar situation and they're also looking to partner up? What are some key things that you'll be looking for in a partner, so that you could sort of mitigate going down this path again in a different strategy, of course?
Yeah, I mean, I think it's different where you're one-to-one as a joint venture partner, right? So you're going to obviously have your partnership agreement in place. There's going to be, I think, precautions kind of set up so that it's not like they can drain the money from the account. Like, you are pretty secured in that respect. But I think you just want to make sure that they have a proven track record of business And I wouldn't say take for granted like how long it can happen, because there's someone in my community that's been doing this since I think 2012, and she just filed bankruptcy for one of her companies. And I think it stems potentially from a bad partnership she had with that particular company. But at the end of the day, there's $14 million worth of private money and only 2 million of assets to back it up. So I wouldn't say that the time someone has been doing this is necessarily the only way to prove their value, because anything can happen at any point in time, right? But I think you still want to see their track record, understand the full scope of everything that they've done, understand other partnerships and businesses that they've had, because it can eventually, you know, I don't want to say blow back on you, but if anything ever happens, then you have to understand everyone that they're in bed with, so to speak. So you want to understand the full scope of their business and any partnerships that they have.
Yeah. No, that makes sense. On the flip side of things, what advice would you have for someone who's looking to get started in real estate, but maybe they don't have the same situation where you've had like an excess of capital that you decided to put into real estate. They have
Yeah.
minimal capital, but they know real estate is a great strategy for investing. They're
Yeah.
trying to get in that way, maybe build up the experience and then attract joint venture partners such as yourself. What advice do you have for them?
Yeah, I think sometimes people that are in the GTA can be really intimidated because it's expensive here, right? So you're not going to necessarily see cash flowing opportunities. I'm not going to say that there's absolutely nothing, but the reality is that it's expensive here. So if you don't have a lot of money, you can always start somewhere else, right? So I think in the Midwest, for example, you could pick up properties that you could turn into a midterm rental, and you can pick those up for like $100,000 US. So even with the conversion, that's maybe 140,000. You put $20,000 or $30,000 down instead of like $300,000 down, and at least it's a way to get your foot in. And yes, there might be
Yeah.
a little bit of added complexity of the fact that it is in the States, or maybe you're going to a rural market or something like that. But you want to make sure you do your due diligence in respect to the demographics of the community. Is it a growing community, or are they losing people? But there are so many options and opportunities in the States where I know people that have done very, very well with like short-term rentals in various places, or with the midterm rentals. And it's just a lower barrier to get started, just because their housing market is not the way that it is here.
Speaking of that, though, how do you stay informed about market trends and opportunities, and what resources or advice do you have for people out there looking to do that?
Yeah, I mean, I think that obviously the media is very focused on real estate these days. But because I do have my real
Yeah.
estate license, I get a daily email from Korea, basically with all top headlines of the day. So I'm always kind of checking those out. I'm also part of an agent accelerated program with Zoocasa that my brokerage acquired. So I get all of their up-to-date things. We have a daily huddle at 9:30. So that's just mainstream news. And then I'm also part of 2 real estate investing communities. So one of them has about 3,400 people on a Facebook group. So there's always kind of chatter in there. And then I'm also part of a mastermind with about 60 other investors. So we're on a chat in Discord. So again, people are always sharing resources and things like that. And then we get together once a week for different calls. So we have an expert speaker once a month. We have a roundtable where we share resources. We've got one topic, which is like best in request. So you can share a win, or you can share a request that you might have if you need support with something, or a referral or an introduction or anything like that.
Love that. And I think a big takeaway that people can get from that is just purely putting yourself in places where these discussions happen, like
Yeah.
in the firing line of getting all this information, right? In as
Yeah.
many places as possible, really.
Yeah.
I love that. That aside though, are there any specific tools or resources that you'd recommend for new investors and people who don't have access to the realtor tools that we have on our end? Are there specific ones that stand out most for you?
Yeah, I mean, from a real estate investing standpoint, obviously I have access to some of those tools. So when I was doing due diligence for private lending, even having access to Geo Warehouse was a big resource, because I could look up who's on title. And that's actually something that came up with a lend I did last year. When I looked it up, the person that wanted to borrow actually wasn't on title, his parents were. And I was like, well, this doesn't hold any weight if he defaults. So we have to add the parents to the agreement if you want to guarantee it, right? So having access to those things. So if you don't, if there is a real estate agent that you can at least explore some of those things. Otherwise, a lot of Service Canada, you can run reports and even just check the property history and how much it's been refinanced and stuff like that. But I think it really comes down to just having the appropriate people in your corner. So having like access to a real estate lawyer, an accountant, a realtor, just trying to understand some different things. But yeah, I think being part of the communities is probably one of the biggest things that I would suggest.
And what's your take on, especially new investors, deciding when is it the right time for me to enter a free community versus a paid community? And that could be in the form of coaching or even just like a mastermind of sorts, though. Now, I know personally for me, I see, and I was actually just before this, I was speaking to someone that's in one of the same groups that you're in, and the value I see is being around those individuals and building those relationships on these higher net worth individuals. What's your take on that? And where do people decide to pay versus the free route?
Yeah, I think when I joined, I don't think there were really as many free resources or anything back then. It got me started. What I would say about the community I initially joined is that there wasn't a lot of structure. So it came with, tickets to an investor summit and coaching sessions, but there was really no structure with the learning. And there is a new group that came out that I wish had been around back then because it's very specific to a stream that you would follow, like multifamily, land development, US, or wholesaling. And then there's modules where you literally educate yourself and then you have an accountability coach every 2 weeks. So it's very, very structured in terms of what you want to learn and how you're going to gain information and stuff like that. So I think you just need to understand what you want to focus on. But if you don't have any money starting out, I think there are so many groups on Facebook. I think just find other people that you can learn from and ask questions of and stuff like that. It's just a matter of putting yourself out there and getting to know people. Like when I joined my mastermind, for example, like when we had our introductory call, I made notes on all the different people and who I wanted to get to know better. And like if they were focusing on strategies that were interesting to me. And then I just set up calls with all of them, and then just actively and consciously try to make an effort to get to know them. So I think that people are generally, they're kind and they're generous and they're open to sharing and stuff like that. But it takes you just putting yourself out there to ask.
Yeah, no, absolutely. I couldn't agree more. Now, we've highlighted a lot of risks and a lot of, based on what's currently going on right now. I like to balance this out with the good and the bad.
Yeah.
What would you say is the most rewarding part of being a real estate investor for you?
Yeah, I mean, for me, when I started to go into it a little bit more was really because I was at a point where I was looking to start my family and I just didn't want to take more money out of my company than I had to because I knew I was going to be taking a step back and I just wanted to leave the retained earnings in. So by investing in like the syndicated mortgages and the private lending and stuff like that, I was able to cut my pay in half. And then COVID started 3 months after my daughter was born. So I literally stopped taking money out of the company for a couple of years. And I was able to literally live off of private lending like since then. Like, and at one point I would say like very, very comfortably. And even now, like, yes, I have some things that have been paused, but what I still do have coming in is at least covering my base expenses and stuff like that. But I tried to be very smart, like with the amount of money I had coming in, it was more than I needed. So I was always just like paying down kind of what I used on my HELOC and stuff like that. I think that for me, having a young family, like had COVID happened and I wasn't doing this, it would have been a very stressful time to have an infant because it's not like I'm going to go get a job when she's 3 months old, right? So it gave me that time with her that I never would have necessarily had if I hadn't really been doing this. So I am still grateful for that. I would say like it's been far more positive than negative. And again, we're learning from all these lessons and I'm still, cautiously optimistic and stuff like that. But at the same time, it gave me way more time than I think I ever would have had if I hadn't been investing to begin with.
Speaking of time, I know for a lot of investors, their journey and how they view things is getting active. Maybe it's starting out on wholesaling or flips, moving into actually acquiring properties, building up their equity and their net worth that way. And then for a lot of them, the end goal is private lending.
Yeah.
Because that's seen as the least active of them all. You have experience with this. How active would you say you found the private lending side?
I mean, it wasn't really that active aside from just like checking your deposits as they come in until all of this happened. Like when all this stuff happened with the insolvency and the CCA stuff, initially we were all appointed to the same lawyer. And then the secure didn't want to share the same lawyer. So then when we met our new lawyer, someone reached out and said, share their email. And basically I ended up teaming up with her to onboard all of these people into a community where we're I think we've got 12 sub chats on WhatsApp, and we have all these Google Sheets, and there's, questions that we're relating with lawyers and borrowers and stuff like that. And literally for about a month to 6 weeks, it was the busiest I've been in 5 years. Like there were some days I'd be on the phone from like 9 in the morning till 10 at night. It's like the exact opposite of passive. But because I kind of put my hand up with someone else to try to help bring everybody together, there were so many investors that wanted to reach out and talk. And I think they're just all very stressed. They don't really have anyone else that they can talk to that understands, like, especially if, they're the one person in a family doing something like this. They can't really, they're just going to be like, well, why would you have done this? Like, but at least we're all in this kind of together, right? So it's kind of created this support network, but it was very overwhelming for like the first 4 to 6 weeks while we were just trying to understand like what is even happening. So, just make sense of it. Like you'd wake up in the morning and it was that there would be like 400 messages and so many emails. And even now, like I'm still getting people that were onboarding and it's about 3 months in. Even today I got 3 more emails. Like there's just more and more people coming out. So it's impacted like tons and tons and tons of people. So in a perfect world, you just see those deposits coming in. Very little time. It'd be like 10 minutes a month. But, obviously when things have gone down this path,
sideways,
not common, but it kind of became something entirely different.
And I guess aside from that, it's just the initial upfront due diligence that's done, and then that's about it.
The paperwork, the due diligence, like, ideally engaging a lawyer to look things over, and there might be extra things that they look into that you wouldn't have access to. So even though there is an upfront cost to that, I think it definitely saves you more in the long run, and something that I regret not spending more time on because I trusted the fact the mortgage broker had their internal like in-house legal and, just again, trusted them as a professional that should be helping to protect you and keeping your best interests at heart. But like I said, lots of lessons. So
lots of lessons. Well, look, I know we need to wrap this up, but I don't want to wrap it up without just doing one of my favorite segments of the show, and it's called Time Capsule. So let's imagine that you've stumbled across a time machine that allows you to travel back and forth in time. Now, of course, you can't change anything, but you can give your younger and older self advice.
Yeah, I think just not to rush anything. Like I said, when I joined the one education company and I went to the investor summit, I did the pre-construction stuff. It was the opportunity at hand. And looking back, that probably wasn't the best step. And maybe that was rushing it, just being like, okay, well, this all makes sense. But looking back, I think multifamily would have made a lot more sense. And I could have, repurposed that money over and over again. And I think just taking the time to do your legwork, explore options, really just not rushing into anything, I think is really, really big. And again, just living by your boundaries. Like, I think for me, I had this idea of how I wanted to be diversified and, I got a little bit comfortable and compromised on that. And, now I'm dealing with these situations, but I think you have to set those very clear rules and boundaries for yourself and just set up ways to protect yourself and mitigate risk.
I love that. Oftentimes it's the advice that I hear is like on the complete opposite end is like, hey, I should have taken action sooner. And of course, there's that happy balance between the two. So for certain types of people, this advice is more applicable, right? Is be a little bit more cautious and don't just jump into things. And then for other people that don't really take action, it's the other way around. But I like that perspective on it, though. Now, if we had to head to your 80th birthday, what advice do you imagine your future self would offer you at your current age?
Oh, good question. Yeah, I mean, there's kind of a quote that says only those who risk going too far will ever know how far to go. So I think even though, yes, there could be some setbacks and stuff like that, I would be where I am had I not taken some of those risks. So I think you still have to, do what's going to be right for you and take action. Just try to educate yourself along the way.
I love that. Oh, I love that. Okay, so what I will do is I'll be sure to leave all your contact info in the description below. So people listening out there, if they're like, hey, I love this episode, I want to learn more about Serena, I just want to follow along, all your info will be in the description below so they can just click through and follow along. But Serena, this has been an amazing conversation. I've had fun. Thank you so much for coming on and sharing.
Great. Thanks for having me.
Thank you for tuning in to the Wealth Through Real Estate show. If you found our deep dive into successfully scaling your portfolio helpful, you won't want to miss our interview with Steve. We explore Steve's journey from living flips to land development. It's a treasure trove for anyone looking to scale up the real estate game efficiently. This is your host, Alray Noble, signing off.